October 23rd, 2023. It was a trading range day today, and that becomes pretty obvious over here when you start getting big bear bars. Additionally, we had a strong spike early in the day, which hints towards the trading range day, and these bars were pretty strong too. So, pretty much all the bear bars are getting really strong closes. And when all the bear bars are getting really strong closes, but you're going up, you always got to be suspicious that it's a trading range day, not a trend day. And you can see the magnet we got tested that we ended up testing late in the day was the midpoint of the day. That's pretty much exactly where we closed. And here we were trying to sell off. I thought we were going to try and get to the three high since bears who sold above here got trapped. So I thought we were going to try and vacuum down to here or down to the open of the day. But the closes just weren't good enough. 69, there's a big tail on the bottom. 70, there's a tail on the bottom. Good breakout on 71, but again, a tail. 72 can't close near its low, and then bad follow through on 73. If we were going to get vacuumed all the way down here, probably 71 closes better and you get big follow through. And sometimes that happens and you get vacuum tests late in the day. And so my premise, late in the day, I was short in here somewhere. My premise was that we were going to get to the three high. And once I started getting these pullbacks within the bars and then pullback here, I was getting disappointed and starting to think that I might have picked the wrong magnet and maybe we're not going to get all the way down here. Because if you think about it logically, if this is an obvious magnet, the three high is a very obvious magnet. And so when you have obvious magnets, as the market gets closer to them, it accelerates into them because the probability that you're touching it is getting higher as it gets closer. And so basically, like if we even got to the open of the day, I thought if we got to the open of the day, we were going to quickly get down to here because we're at this magnet and it's so close to this magnet, we might just get vacuumed down. But if that's going to happen, traders are going to be selling this close aggressively, knowing we're probably going down here. And so if that's going to happen, you're going to get big bear follow through bars. And we just didn't get those follow through bars. We started getting sideways price action, which told me we had probably already reached the magnet we were going for. And since it's a trading range day, it's reasonable to think that that magnet, like I said, is the middle of the day. And that's where we were. So that ended up being the magnet we were looking for. But I still do think if we get down to this three high tomorrow or something, there should be buyers. So bar one, big bear or bear bar, bear reversal bar with a reasonable close. Something to keep in mind is that when you get a spike on the open, there's an 80% chance that it's a trading range open. So even when you're getting strong follow through like this, there's an 80% chance that we're going to actually end up being more sideways rather than straight down. And most big bear trend days don't start with like 5, 6 strong bear trend bars. Most of them start, a couple, but you see it's sometimes more sideways and you don't just get straight off selling. This isn't the best example, but you see we had a tight trading range on the open and not just straight selling. And the reason is because 80% of the time you get a minor reversal on the open. So, it's hard to want to be short in here. You can be, but a lot of traders, the moment we start to rally, they're going to exit their shorts. And that's what caused this bounce. Additionally, we have a pullback on the tail of one, down, and then up a little bit on two on the tail, and then down and up even more on three. So tail's getting bigger, 80% chance of a minor reversal. So if you're short below two, which is fine, it's sell to close. So maybe we're going to get a sell off on the open in a trading range day, but this could definitely keep going. So it's fine to sell the close of 2 or 3. You just have to be aware that you need to get out quickly if it starts to do this. So if you sell below 2 or you sell the close of 3, you can't be getting out up here. You probably just need to get out above 3 or a couple of points above 3. Because if it trades above 3, your premise that we're just going to immediately sell off. Because if you're selling below 2 or selling the close of 3, your premise should pretty much be that we're just going to continue to sell off and get big, strong bear bars. And that's obviously not happening if you're going above 3. So your premise is invalid. So a lot of those traders are exiting, and that's what's causing the rally up on 4. 4 is an interesting bar. It's potentially a reasonable swing buy because after 3 strong bear bars, you're going to have trapped bears, and you have bears who sold above 3 who are now trapped. And you have any bears who sold, below 2 and during 3, some of them are trapped too. Some don't get out. Some end up taking a full loss, which isn't good, but that is what happens sometimes. So it's reasonable for bulls to buy above here, thinking that we're going to get a swing up. On the other hand, this is 3 strong bear bars, so it's most likely that these traders are going to be able to get out. And you can see on the tail, bears used any sort of drawdown to exit, and we were not able to get back to that 3 high. So I thought it was a better buy about 5 once you know that you have these traders trapped, because once you get follow through, generally you should consider those traders trapped. they're potentially trapped on 4, and you can buy hoping that they're going to stay trapped. But once you get follow through, a lot of traders are waiting to see if those bulls are able to get follow through on 5. And once they do, a lot of traders start to exit, and that causes 6. It's 3 good bull bars, so probably at least enough for a small second leg. Um, Inside bar on 7, we're starting to get scalping as we touch the moving, or sorry, not quite an inside bar, a bear bar on 7. It's essentially a doji. Starting to get some scalping as we touch the moving average. Inside bar on 8, bulls will probably exit below 8 if it triggers. And there's a couple things to keep in mind. One being that we got up above the 1 high and we didn't pull back into it. So we have an open gap here. You could argue that the tail on 6 traders could maybe sold above and scalped a tick, but it'd be insanely hard to do that. And so the reality is the majority of bears are not doing that because it's so difficult to do that. So most likely bears are trapped, but bulls know that if we trade below 8, those bears are probably going to get out. So bulls will buy the close at 8, trying not to let those trap traders out, and they get good follow through on 9. We trade back down to the 8 close. Any bears who were front running 8 ended up buying back their shorts around break even, and that's why right here on 9, when we touched this close, we found we got a rally. We also dipped slightly below a 9 to run some bull stops. And when you run bull stops like that, it starts to get bought up again. A lot of bulls will have to buy again above 9 as it trades above, because now they're trapped out, and a lot of traders are trapped out. So when the more traders are trapped out, the better chance there is of a significant rally. But the tail on 10 is a problem, and you get some follow through on 11, but this could be 2 legs up, 1 pullback 2, or it could be 1 pullback 2 pullback 3. So it could be a wedge, it could be a second leg trap, and that's the problem with 12. Right? You can't really sit through 12. I understand that this is pretty strong and this is all strong enough to get a second leg up, but you have to get out below 12. This is a pretty tight channel though. I wouldn't sell below 12. It's a low probability swing, but I would get out of longs below 12. And if you did sell below 12, you get good follow through on 13. It's what you want. You maybe wanted a stronger close, but it's in general what you want there. And then the problem is though, this is strong enough. It's a breakout on a higher time frame, right? So if you look at the 15-minute, I should have it here. If you look at the 15-minute, it's a breakout on a higher time frame, so it's probably going to get a second leg up. So, I personally, so a lot of traders are, quickly scalping out on 13 with, I don't know, what they make, 5 points, 6 points. So they could have at least made 5 points, and that's when you get 14. Now, 90% chance we break out of the opening 18 bar range, which we're still forming, so we're probably going at least a little higher. You could buy above 14, hoping that we're going to get a second leg up. I think that's okay, but it's right on a flat moving average and a small tail on the top, so it's not the best. And you get good follow through on 15, but it's not closing above, it's not breaking out of anything. So I don't think 15's, a very good buy the close bar. Additionally, anyone who bought the close of 11, think about how you're feeling if you bought the close of 11. You're disappointed in how this has gone so far. So a lot of those traders are going to start exiting, as soon as we get near that price. And a lot of those traders exit, and that causes 16. And then some bulls held, hoping that we got 14, 15 good bull bars. 14, 15 good bull bars, and maybe we're going to get stronger follow through. But they get disappointing follow through on 16. And so during 17, they're getting out of their longs. And that's why there ends up being a big tail. Because when you traded up here, those bulls were disappointed and they scalped out. And that's going to cause 17. 17 is a double top, but you're at the top of essentially the 18 bar range. So very likely we're going here. And additionally, if we start to sell off, there's a lot of time to get in. It's a double top. So you could sell below the breakout below the neckline of the double top and hope we get good follow through back down to the obvious magnets, the 3 high, the 3 close. And if we get to the 3 high, realistically, 90% chance we're breaking out of the 18 bar range. So that means we would get down here if 17 works. So there's no reason you need to get in right below 17. I think bulls, this is too strong for the bulls for me to want to sell below 17, because I still think we're probably going to get a second leg up. But if 18 had been a big bear bar like 12, then that's a very credible sell for a swing. But I would rather wait for follow through once I see 17. I think 18 is potentially a reasonable buy. I think it's a good buy. It's a tight trading range. It's a triangle. You are in a little middle of or the top of a tight trading range and potentially an overall trading range, but it's a triangle breakout. It could be a final flag, and it could be one, pullback two, pullback three. So it could be a couple pushes up. And even within the trading range, it could be 14, 15 leg one, 18 leg two. So a second leg trap. All of those things are possible. However, still 90% chance for breaking out of the 18 bar range. Still likely that this is going to get a second leg up. So I think it's a pretty good buy. 19 is interesting. You can see where it dips down to. And if you take the 1-to-1 of essentially where your stop would have to be, because true risk is where, true risk isn't, you can't see it until after the market goes, but the true risk of buying above 18 ends up being right here below 19, and then your entry price would be one tick above. So your stop only had to be here. You don't know that until after it goes, but after it goes, your stop only had to be here. And look where it is. No surprise. The breakout of the 18 bar range ends up being a 1-to-1 scalp of that. So a lot of traders will see that we get this tail, and then they'll see 20 starting to rally, and they know that their true risk is only exactly 1-to-1 of this new high. So it's reasonable to scalp out at the new high because you're getting 1-to-1 of your risk with a good probability. So that's what's happening on 20 is you got traders scalping at that high. 21, more follow through for the bulls. The argument that it was going to be a one pullback and a big second leg up is still valid. So you get follow through on 21, on 22, and more follow through on 23, but big tail on the top, big tails over here. And additionally, something you have to keep in mind is why is 1, 2, 3 so strong, and why are 12 and 13 so strong? Like, why are these bars closing so strong? We do have potentially two open gaps. We have this open gap. We have this open gap. So that's good for the bulls. But why are these bears getting such strong closes if this is such a strong rally? So it's kind of, you have to be a little suspicious of what's going on. But you end up getting good follow through 21, 22, 23, pullback 24, and inside bar on 25. At this point, it's a pretty good rally, and this was potentially a final flag for the bulls. So you got to be thinking we might go more sideways here and try to get some sort of major trend reversal. And a big bear bar on 27 closing near its low. I think if you're long for any reason, I think getting out below 27 is the smart move. It's potentially one pullback, two pullback, three. So it's potentially three pushes up after a couple pushes up. So some sort of, consecutive wedges. And it's a strong bear bar closing near its low. And what was your premise really if you were buying up here? That we're in a strong bull trend. And should this close be this strong if we're in a strong bull trend? Probably not. So a lot of traders exit below, and that causes, the tail on 28. But limit order bulls come in buying, knowing they can buy more lower, and they're probably going to be able to scale in and make money on the basis that this is pretty tight too and should get a second leg. So we get a rally on 29.30. You can see the bulls who bought the close of 26, disappointed 27, ended up scaling in lower, and they were able to get out around break even during 30. 31, inside bar, bears trying to get some sort of double top with this being the neckline and a major trend reversal. You could argue 33 is the double top. And you get follow through on 34. 34 is a big bear bar closing near its low, but this is all pretty strong. So, that's basically the moral of, this piece of the day is the bulls were pretty strong. So it's going to be hard to want to sell these bear breakouts because realistically, they just very rarely get follow through. They always kind of seem to need one more bar and don't ever seem to get it. And you can see 35 breaks out of the neckline of the double top. You have a double top, 27, 33. And 35 breaks out of the neckline and immediately reverses. So this is a key breakout point below 28, and we end up getting a reversal up there. What does that tell you? That tells me that bears aren't that strong. Now, they're getting these strong closes, so it might not be as bullish as you want it to be, but it is a potentially reasonable buy above 35. You get follow through on 36, and then an inside bar on 37. I would just be waiting at this point. Again, another potential final flag. And what's interesting is that 39 and 40 is an inside-inside pattern. And what an inside-inside pattern is just a triangle on a smaller time frame. You can see how, an inside, I'll do this. This will be easier. So triangles have this shape. They're contracting. They're a contracting pattern. And inside-inside bars have the exact same shape. So an inside-inside pattern is just a triangle on a smaller time frame. On a smaller time frame, this is, up, down, up, down, up, down, up, down, and then coming to an apex. And here it's just up, down, up, coming to an apex. If that makes sense. So We're at the apex of a triangle on 40 and probably a reasonable buy above 41, considering a lot of final flags have a breakout that's good for a scalp. Uh, and this is a triangle and an II, so very much potential final flag, reasonable buy above 41, and big follow through on 42. Bulls get at least 10 points. I would just, a lot of them see that and look at 42. It's the best bar of the entire trend. You could argue 4 was a better bar, but that was the first bar of the trend. We're now basically 30 to 40 bars into this trend. If this was the beginning of a new trend, it'd be fine, but it's an overshoot of a channel line. The context is terrible. It's an overshoot of a channel line. It's super deep in a trend. So this is very likely to fail and be a place where bulls are going to take profits, and that's exactly what they do, causing 43. Bad follow through on 44, and then bears get another leg down on 45 and 46. But what do you notice about this whole thing? So first off, this is a climax, so we might have to test back up here, but we probably don't exactly have to. And bulls will buy again above another bull bar, say 49, and try to get out at break even. And you can see if you bought the close of 42 and you bought more above 49, you were able to get out pretty much exactly at break even during 52, and bulls were selling, and that's what's causing 53. But what happened over here was it's 1 pullback, 2 up on 45. So it's 1 pullback, down, up, 2, down, 3. So what is this? This is essentially a wedge. And sorry, a couple things. Limit order bulls who bought below 44 should make money as well because it's a doji bar. So there's multiple reasons there's resistance right here. The reason I mentioned the bulls buy above here, buy more here, and this low. So lots of reasons there to be resistance right here. It ends up being a double bottom on 49, and you get follow through on 50, 51, 52 to this low, but just not all that good. You could argue that we're going to get another leg up, but usually if we're going to get another leg up, then we would have started going more sideways earlier. I think the best case scenario for the bulls is up here right now, but it seems more likely that we're just going to continue sideways to down. Bears would argue you got an overshoot and then a higher high, potential major trend reversal here, and then you have the lower high on 53. So 53 is probably a reasonable swing trade. Follow through on 54 and 55, but a failed breakout below this low. Bull bar on 56, and second leg down for the bears from this on 57, 58. But it's potentially 3 pushes down, so it's really hard to want to buy, or sorry, to want to sell down here when it's potentially 3 pushes down. Some bears would argue it's a breakout of a bull flag, but the breakout is not all that convincing. Is the problem? It failed once, and then it almost failed again, but it's just getting bad follow through when it needs to get good follow through. So, while the bear argument of the breakout below the bull flag is somewhat valid, if you're selling down here, you're selling a third push in what's probably a trading range, so it's not that good. Bad follow through on 59, probably sellers above, probably buyers below, sellers above on 60. Bear bar on 61, but you're now selling a 4th push down, not a good idea. 62, potentially a relatively major reversal. You could buy above 62. I think, the 51 or the 52 close is an obvious magnet. This close is an obvious magnet. So I think it's reasonable to buy above 62, but the problem is this bear channel is pretty tight and it might get another leg down. So if you buy above 62, you want fast follow through, and you don't get fast follow through on 63. So what happens on 64 when we're around this price? Bulls are scalping out of their longs. You can see we started to race up on 63. Bulls bought. They're trapped. They're getting out around break even on 64. Inside bar 65, outside bar 66. 1, 2, 3, 4 dojis in the last 8 bars. Better not to trade. 50% chance the first breakout fails. Pretty much relatively 50-50 market right now. And you get essentially a breakout attempt on 67 and it fails 68. Some traders might sell below 68, citing a breakout attempt here, breakout failure, and you can sell below that. But lots of dojis you're selling in the middle of a trading range. I'd rather sell lower. And then you try to sell lower on 69, but it gets bought up, so you're disappointed. And then you get 70, it's an inside bar, but it doesn't close on its low. If it's an inside bar that closes on its low, it's a better sell. But it doesn't. But a lot of traders take it anyways, hoping that, sometimes what trends will do is they'll look not quite good enough, but you can get short, Some will just sell below 70 saying, well, maybe we're going to collapse. And occasionally you will, but it'll do kind of this stuff the whole time that traps traders out and forces you to chase the market. And in forcing you to chase the market, it can go on for longer because it keeps trapping traders out. And so I thought we might do that, but you bad follow through 71, bad follow through 72, can't quite close on its low. Doji on 73. I think 74 was essentially the last attempt. And then we got bad follow through on 75, and traders gave up around the close of 75, causing 76, second leg down, and went very sideways. For always in, I thought it was always in long. It was potentially always in short. It came into the day always in short, but we didn't flip to always in long until probably 4. Definitely on 5. I think bulls have to exit below 12. If they can buy again above 14 or 18 and hold long, exit below 27. It's probably okay to buy 35. It's just the top of a trading range, and it's big risk, so it's sketchy. I think probably a better buy above 40, 40, 41, and they'll exit, ideally on the close of 42, but if you're trading always in literally, maybe below this bar, below 43 during 45. Probably an okay swing sell below 53. It's kind of unclear in here, but I think 53 is a reasonable swing sell. Hard to say it went clearly always in short, though. You got to, you're starting to think one bar will, change the always in direction. I thought 62 might, especially if we got follow through, but we don't get follow through on 63. So we continue sideways. Fail breakout 67, and you can sell for a second leg down. You could sell, below this or that close, sell below there, etc. On the daily chart, bull bar, disappointing for the bulls and disappointing for the bears. So trading range behavior. Be interested to see what we get tomorrow. Regardless, a couple of options. Bears might sell this close, disappointed in this close. So it's possible we get a short covering rally tomorrow. It's not super likely, but it's possible. Most likely we'll get some sort of disappointing inside, maybe an inside bar, but some sort of very disappointing bar, and low probability of just a straight sell off again tomorrow. Bears selling the close. Weekly chart, very important to see if bears can get follow through from 1016. If they can, then, maybe we can sell off somewhere down here. But you need another strong bear bar closing near its low, and it's a third leg down in what's probably a trading range. So I expect this weekly bar to be disappointing for the bears who sold below here. All right, that's the